Hey traders and investors, it's Serge Berger here. What I'm going to take a look at today is a little bit of clarification on how we can trade the trend or basically do the trend following game that so many institutional investors out there are trying and are to some extent successfully doing. I think there's a little bit of misconception out there based on the amount of comments and questions I got over the past week or so on trend following. Um, and that's basically people think you really have to just stick in the trade and stay in it until the trend ends. And I think, that certainly is one approach. Uh, for people that want to stay in a trend and trade the trend for longer than just a couple of weeks, however, that tends to be a very difficult game to do, just at least from a psychological point of view, because you can have major corrections in a trend. So we're going to look at today. Here's VMware, VMW is the ticker symbol. This is a technology company, more specifically a software company, and they sort of make visualization software. Competitors are like I think Microsoft and Oracle in that space. So if you look at the trend, really obviously started in 2009, like most stocks did. But if we just take a very simple Fibonacci retracement level and move it to the top here, that took place in April 2012, you can see that we more or less retraced 50% of this entire rally before we started rallying again. That's the real big picture. What I'm a little bit more focused on, though, is the trend or the upswing, really, that we have had ever since July of last year. And if you look at the movement here, you can see that by just drawing a few very simple lines and using the basic 50, 100, and 200-day moving averages, although of course you can use different ones, whatever you prefer, but those tend to work very well for VMware at the current juncture. You can see that once the stock started breaking lateral resistance, you really had the beginning of a trend with this big up gap. At the same time, though, if you would have stayed in the position here, you would have made some money, but you would have frustrated yourself out by the up and down moves. So you have to define yourselves by some moving averages. So the stock then retraced a good amount, probably just around 50%, and ended up holding its 200-day moving average. At this point, for those people that were a little bit more, wanting to kind of trade this move a little bit more proactively, you then got another trade on the long side, all with the trend in mind, on the breakout past near-term resistance on December 4th of last year. The stock then proceeded very much higher, but again sharply corrected here in January, which was very frustrating for those people that hold something, I guess, just for a few weeks or maybe a couple of months. So here too, it pays to sell into strength and buy dips when you follow a trend. At the current juncture, we are basically have just overcome the January 2014 or just a few weeks ago highs, and we're now through the lens of a sort of almost multi-year view. We're coming into a critical resistance area, which really dates back to May 2012. However, we are curling up underneath this resistance area, and we're forming a very tight formation here, which is basically, I guess you can call it a bull flag formation. It doesn't matter. We're just consolidating below a very important resistance area. Credit Suisse just came out yesterday with a positive note on the stock. I do think if and when the stock breaks past, say 103 ish, a little bit above that, maybe 103.20 or something, it can definitely move into the high 100 teens, so somewhere towards 106, 108, maybe $110. So that's the way to stick with a trend following type of stock. Doesn't mean you have to stay in it and just frustrate yourself every day, every time there's a pullback. Look for the patterns that are developing in the trade, in the trend, in the direction of the trend. Hope this makes sense. As always, any questions, you can tweet me at my Twitter handle, which is SteadyTrader. Take care.